All right, so in this video, what we're going to look at is how to find the value of a stock that has non-constant growth in the dividend. So let's take a look at our problem. So in this case, we have a stock that paid a dividend of $4 per share yesterday. We are to assume that the dividend is expected to grow at a rate of 20% per year for the next 3 years, and that the dividend is expected to grow at a constant rate of 8% per year thereafter. If the rate of return required by shareholders is 15%, what is the expected price of the stock today? So first, let's draw out a timeline so that we have a better understanding of what's happening and when. So notice that it's growing at a rate of 20% per year for the next 3 years. So let's put several years on here. Okay, so if time 0 is today, and it's growing at a rate of 20% per year for the next 3 years, let's put the growth rates on the timeline. And after year 3, it is said that it is going to grow at a constant rate of 8% per year thereafter. Okay, so notice that step 1 is to draw our timeline. Step 2 is to put our growth rates on the timeline. And now step 3 is going to be to find the dividends that we can put on this timeline. So notice that the problem stipulates that the stock paid a dividend of $4 per share yesterday. So if I buy the stock today, I don't get that dividend. But let's take a look at how we can find the other dividends though. So if D0 was equal to $4, D1 is equal to D0 times 1 plus the growth rate. And in this case, D0 is $4, so we'll substitute in there. And then the growth rate on our timeline for this first year is 20%, so 1 plus 0.20. Okay, and so at this point, I will give you a moment to pause and to work that out and to see what you get. Okay, so if you pause the video to work that out, what you should have gotten is $4.80. So D1 is $4.80. Well, now we need to find D2. So to find D2, we're going to take D1 and multiply that times 1 plus the growth rate. So we're going to take $4.80 times 1 plus the growth rate. And I will again allow you to pause the video to try to work that out to see what you get. Okay, so if you pause the video and work that out, what you should have gotten was $5.76 for D2. Now, once I have D2, I can find D3 because that's just going to be equal to D2 times 1 plus the growth rate. So $5.76 times 1 plus 0.20. And again, I will pause and recommend that you work that out to see how you do. Okay, so if you pause the video to work that out, what you should have gotten was $6.91, and I'm going to hang on to some fractional change here. So $6.912 for D3. Now, in the back of your mind, you might be thinking, okay, so how many years worth of these dividends do we need to find? Well, for reasons that will become a little bit more clear in a moment, what you need to do is you need to go 1 year into the period at which it is turned into that constant rate of growth. So in this case, because we are growing at 20% per year for 3 years, and then growing at 8% per year thereafter, we need to go up to D4. So we need to find up to the 4th dividend. So we need to find D4. So I'll hang on to those decimal places. So we'll have $6.912 times 1 plus the rate of growth. And here is where people can get into trouble. Notice that for years 1, 2, and 3, the growth rate was 20%. But for year 4, the growth rate is 8%. So we need to use that 8%, which in decimal form would be 0.08. And so I'll give you a moment to pause the video and work that out and see how you do. Okay, so if you pause the video and work that out, what you should have gotten was a value for D4, which was $7.46, and then some fractional change here. So I'll hang on to a few extra decimal places until we get to the end. So 7.4650 works out nicely. So our first step was to draw out our timeline. Our second step is to put our growth rates on the timeline. Our third step is to find dividends. And now the next step here is going to be to put our dividends on the timeline. So let's go ahead and do that. So 4.80, and then we're going to have 5.76, 6.912, and then 7.4650 for year 4. All right, well, now that I have some cash flows on the timeline, you might be thinking, well, all right, this kind of starts looking like a time value money problem. And you're right. So let's lay this out as a time value money problem. And I'm going to draw a line here just so we can keep our calculations separate. So if I start working this out, my expected current price of the stock should be the present value of all the expected future cash flows, which are our dividends. So to do that, this is a future value, so I'll take 4.80 divided by 1 plus our required rate of return. And our required rate of return in this case is 15%. So in other words, if we go back a little bit, KS is equal to 15%. And as we've already identified, our first growth rate, our supernormal growth rate, was 20%. And our constant growth rate was equal to 8%. Okay? So 1 plus our required rate of return of 0.15. So this is a future value over 1 plus our rate of return. So this is finding the present value of that first dividend, plus 5.76 over 1 plus 0.15, and that whole denominator raised to the 2. So I have a future value, dividend 2, divided by 1 plus a rate of return, or an interest rate, raised to the 2. So I'm finding the present value of D2, plus 6.912 divided by 1 plus 0.15 raised to the third. All right, so at this point what we need to do is we need to kind of step back a little bit and reevaluate what we're doing. So we found the present value of the first dividend, present value of the second dividend, present value of the third dividend. That part's fine. But notice that on our timeline it becomes a constant rate of growth from here on out. And so we need to figure out what the value of this stock is and incorporate all those dividends. So in that case, let's imagine for a moment that we didn't have that first part of that timeline and we were standing right here, okay? Just a little bit past year 3, and I've drawn a little stick figure to denote that, and we were looking forward into the future. So if we were standing right there looking into the future, would this look like a constant growth, non-constant growth, or no growth stock? Well, if you're thinking this looks like a constant growth stock because it's growing at 8% per year, you're right. So this would be a constant growth stock if I was trying to find the value of the stock right here. And as it turns out, we have a formula to find the value of a constant growth stock, and that formula is this. Which should look familiar if you've been doing the videos and watching doing the problems in those other videos and explanations and so forth. So in other words, I take the dividend a year into the future divided by KS minus G, and that would find the value of all this infinite stream of dividends forever if I have a stock with a constant rate of growth in the dividend. So if I imagine myself as standing right up here, right after year 3, trying to find the value of the stock, the way I would do it would be this. I would take a dividend a year into the future for me, divide by KS minus G, and that would ultimately give me the value that I would expect the stock to have. So what we're going to do is we're going to do that. So we're going to imagine that we're standing right here, and we're going to find the value of the stock as of right here where the stick figure is standing. So if I'm standing right there, the dividend that is 1 year into the future for me is this one. And that is why I found one dividend a year into that constant rate of growth. So what we'll do is we'll take our 7.4650 and we will divide by our KS minus G. Now our KS is 0.15 and our growth rate, if we are dealing with this part of the timeline, is 8%, so 0.08. And this term would find the value of all these future dividends as of right there where the stick figure is standing. Okay? So that would find the value of all those future dividends as of right there. Now, if we step back and we look at the full scenario, notice that we're not actually standing where the stick figure is. We're standing over here trying to find the value at time 0. That means that this term, which finds the value of all those future dividends from years 4, 5, 6, 7, 20, 50, and all the ones in between and all the ones beyond that, as of right here, that represents the value where the stick figure is, which is in turn a future value if we're over here. So I need to find present value of that. And to find the present value of any future value, we divide by 1 plus the required rate of return. And in this case, our required rate of return is 15%. So 0.15, and then we need to raise it to the appropriate power. So at this point, I want you to pause the video for a moment and to consider what power that ought to be to find the present value of this term. So pause the video and think about that for a moment. Okay, so if you pause the video and thought about that, notice what we should have wound up with. This term found the value of all these dividends as of right here where the stick figure is, and I need to bring the future value back 1, 2, 3 periods. So I need to raise this to the third. And I hope that's the number that you arrived at. Okay, so at this point what you should do is pause the video to work out each of these particular terms. Okay? So let's take a look at that first term and see how you do. So work out this first term and see what you get. And I'll wait for you to do that. Although you might have to pause the video. Okay, so if you pause the video to work that out, what you should have gotten for that first term is 4.1739. And I'm hanging on to a couple extra decimal places till I get to the end. So that should be what you got for that first term. Now I recommend that you pause the video to work out this second term and see what you get. Okay, so if you pause the video and worked out that second term, you should have gotten $4.35 with some fractional change, which we'll hang on to some decimal places. So 4.3554. All right, so now I recommend that you pause the video to work out this third term. So pause the video and work that out and see what you get. Okay, so if you worked out that third term, what you should have gotten was 4.5448. Okay? And now we have this last term to work with. So I'm going to recommend that you pause the video to work out that last term and to see what you get. Alright, so if you worked that out and you followed the order of operations, so you worked out this first piece here in the brackets and then you divided it out by this part down here in the denominator, you should have gotten a number. And maybe you got a number and you looked at it and thought, that can't be right. And it's possible that you maybe had an error, but it's also possible you might have gotten the right number. So let me put down the number that I got when I worked it out. And what I got was 70.1194. So let's talk about what's going on with that, because you might have looked at that kind of number and thought, wait a minute, that can't possibly be right. But actually it is. So let's talk about why. Notice that this numerator here, the part in the square brackets, that's finding the value of all these dividends from here on out for year 4 and to eternity as of the end of year 3. So if that's finding the value of all those dividends from year 4 and on for all eternity as of the year 3, that's why that gave you a big number. And then when you found the present value of it, it just diminished it a little bit, but it still left you with a really big number. And that's why this last term is so much bigger than each of these other terms. This is just the present value of the first dividend, present value of the second dividend, present value of the third dividend. This is the present value of dividends 4, 5, 6, 7, and on for all eternity. And that's why this number is bigger. So at this point, what you should do is pause the video, add up each of these pieces, and see what you get for the total present value of this particular stock today, which would be our expected price. Okay, so if you worked all that out, what you should have gotten was an expected price today of $83.19. So we would expect that the stock would sell for $83.19 today. Or in other words, this is what we think it's worth. If our estimates regarding the required rate of return, the growth rate for the first few years, the growth rate after that, and yesterday's dividend, if we know all that information accurately, then this is what we think the stock should be worth today. So here's a question to consider. If I could buy that stock for $75, would that be good or would that be bad? So take a moment to perhaps pause the video and consider that. If we think the stock is worth $83.19, but the current stock price is actually $75, is that good or bad? Well, if you pause the video to consider that, you should have reached the conclusion that this would be very good, because this represents what we think the stock is worth, and if we could buy it for $75, that's obviously good, because I'm buying it for less than I think it's worth, and that's a very positive thing. On the other hand, if we think the stock is worth $83.19, and if it's selling in the marketplace for $90, that would be a bad thing, because that would mean that I am being asked to pay more than I think the stock is worth, and obviously we don't want to do that. So that would be a bad scenario. But let's recap the steps that we followed to do this. First off, we drew off our timeline. Second, we put our growth rates on the timeline. Third, we found the dividends using the growth rates. And then fourth, we put our growth rates on, or our dividends on the timeline. And fifth, we did some time value of money calculations here. Now, if we think through this for a moment, it's worth noting that actually you could adapt this methodology relatively easily to handle numerous growth rates during this first few years. So for example, suppose this had been 20%, 19%, 18%. Well, in that case, we really would have done just about the same thing, right? We would have put on our timeline, we would have had 20%, 19%, 18%, and then if it became constant thereafter, and then we would have found dividends. The only thing that would have been different would have been I would have used 20% here, 19% here, 18% here, and then I still would have been back to 8% here. So my dividends would have been different, but the process would have been fundamentally the same. So I recommend that you consider trying out some problems like that to see how you do and get some practice.